Okay, good afternoon, everyone. Thank you for joining. This is our online discussion event, which we will try to organize a bit more regularly going forward. We're going to talk about US election now. Just quickly, just introduce myself. My name is James Chu. I am one of the founding directors of Tricio Investment Advisors Limited. I work with John Calverley, who is our chief economist, and Gerry Celaya, who is our chief strategist. All of us used to work for American Express Charter, and we now work together in Tricio. And what we do at Tricio really is we are set up to be investment buddies. We want to be investment buddies for professional investors, advisors, wealth managers, etc. And what does it mean? We actually give support to these clients on all aspects of investment, ranging from providing independent advice on investment in the investment committee, looking at strategies, looking at portfolio construction, product and solutions development, and also white labeling, producing some kind of commentary or other stuff that you want. So now I hand over to John, our chief economist, have been working for over 30 years, economics for investments, and he wrote 2 books about bubbles and other matters on economics. And I will ask him to start looking at exploring some of the latest on US elections. So John, hand over to you.
Okay, thanks, James. So I'm going to talk about the elections and the implications of a Biden victory, or indeed if Trump were to continue. And then Gerry and James will talk about some of the implications for the markets. So I think the first point to make is that although Biden is clearly the favorite, and most of the polls and the betting suggests that the Democrats will take the Senate as well, it's still too close to call. We cannot be sure about that. We know that polls are often wrong. Much will depend on the turnout, which seems to be strong based on the voting ahead of time, but we'll have to see how that really works out for both sides. There's also the problem we may not get a result straight away, possibly not until December or January. So this is another point to consider. We can come back to any questions you have on that later on if you're interested in the political side of it. But I want to focus more on the impact on policy and the economy. First, let's look at Trump's economic record. I think there's been some progress on reducing regulation, particularly in the environmental area and the labor area. The implications for the economy, though fairly limited, I would say, probably helped a little bit for the economy. And it's probably helpful that we haven't seen a whole lot more new regulation. But I don't think this has really been transformative. The lower corporate tax rate, probably one of Trump's biggest achievements, reducing the tax rate from 35% to 21%. And that had the effect of raising after-tax profits by about 9 or 10% directly. Again, the economic impact in terms of boosting investment is debatable. Investment was strong until COVID, but that was late economic cycle period anyway, when you would expect strong investment. He's also lowered income taxes generally, but largely favoring the better off. There's a much higher government deficit. Even before COVID, the budget deficit as a percent of GDP was 6.3% last year, up from 4.4% when Obama left. That's a pretty high level for, again, low unemployment. Not a good place to start with COVID and have another big increase in the deficit. Trade policy uncertainty, I think that's one of the big legacies of Trump. Certainly it's roiled the markets, but it's also had a major impact on the economy, damaging the US economy, but also other world economies as well. I think it's fair it's been a poor health response to COVID from the federal government. But I think you can argue there's been a good fiscal response. The US has done a particularly large stimulus. And also it's been, at least until now, on lower income groups. So I think that has worked out quite well. In terms of the COVID situation, this is just a screenshot from the Financial Times, which is one of the best sources for this, just showing France, the United Kingdom, the United States, and Canada. The left-hand side I wouldn't pay any attention to because that's before there was much testing. So the actual numbers in all four countries were probably at least 10 times higher than that. The main point I want to make here is that while France and the UK have seen this massive rise over the last really 2 months or so, the US is not seeing such a strong rise, at least so far. They seem to be at a higher level, but not at least so far have they seen this big rise. And if we look at these are populous US states, again, most of them relatively flat over the last couple of months, although showing signs of increasing now. And you see there Illinois increasing. One of the concerning trends is that many of the more northerly states in the US are seeing quite a strong rise at the moment. And that suggests that, like Europe, they're entering into a seasonal period when there will be more problems from COVID. So undoubtedly, a big challenge for Biden or whoever's the next president will be to deal with this. So coming back to the economy and GDP, this is the 3-year average of GDP growth. So you can see on the far right there where I've ringed it, the average for the 3 years to the end of last year for Trump was 2.5% growth. But not very different really from the Obama period, especially the later years. And if we look at the next chart, which shows the fiscal policy stance, this is the change in the cyclically adjusted deficit as a percent of GDP. So you can see in 2008 to 10, there was the stimulus period, then there was the tightening period, and then more recently we had the Trump tax cuts, and then of course the COVID stimulus. So the point here is that Obama had a stimulus period right after the recession, but then there was tightening from 2011 onwards, and that really held growth down. So bottom line is, I don't think there's really any difference in the GDP performance between Trump and Obama after all that. Apart from the first year or two of Obama, which was coming out of the recession, it's been pretty much the same the whole period. One point to make, which I find quite interesting, this is the National Federation of Independent Businesses. There's a confidence index published monthly. Now, these are small businesses. These are restaurants, repair shops, that type of thing. What's notable about it is that there was a huge lift in confidence literally the month after Trump was elected. Before that, confidence had been languishing after the global financial crisis for many, many years. And suddenly it jumped up and it stayed high pretty much until COVID. So obviously these are some of the people that like Trump, probably particularly like the tax cuts. So if we get Biden, this group, we may see the confidence go down. We'll see. So turning to Biden's policies, and what do they amount to? I mean, I think the headlines are a stimulus, probably a big stimulus, some redistribution, a switch towards more green policies, and a more globalist approach. The first item, I think, of his agenda will be to deal with COVID. Now, obviously, Congress has been discussing various plans over the last few weeks, obviously not happening before the election, could still happen before the inauguration, although if Biden's coming in, our guess is that probably won't happen because Trump probably won't go along with it, won't cooperate. He'll leave it to Biden to sort out. So one of the first things Biden will have to do is to get that passed, so a big stimulus program from that. Alongside that, or part of that, or extra to that, will be a large green program involving new investments, but also new regulations. Probably not a federal carbon tax, which would be the most efficient way to do it, but nevertheless a big push in this area. One of the consequences of that for the investment world, I think, is that the US is going to start catching up with Europe on ESG in general. There's going to be more interest in ESG, and there's also going to be more vehicles to invest in ESG in the US. I think the third element, the redistribution I mentioned. So the policy proposal is to raise the corporate tax rate back to 28%, so about halfway back. But in practice, whether that will get through Congress, we'll see, and there may be lots of exemptions, credits, etc. So the details will matter for individual companies. Now, we would expect higher taxes on high-income people, although again, the change may not be huge, and there may be changes to exemptions, credits, etc., which could mitigate that. Probably lower taxes and more welfare for the middle classes. And one point I would really flag is the $15 federal minimum wage. Currently, it's only $7 something, so that would be a big increase. Obviously, some states it's already up near that level, some states and cities, but in many parts of the country that would make a big difference and would be quite a big stimulus, but also put pressure on low wages. I think in general we could expect more regulations, probably more action on the antitrust side. That could particularly affect certain companies, tech sector obviously, maybe pharma, probably financial sector where Trump was deregulating a little bit, and especially on the energy sector coming out of the green agenda. More infrastructure spending. I'll speak more about that in a moment, but I think that's going to be definitely part of it, probably part of the COVID relief bill. And then on international relations, I think a more globalist approach. Now, I want to back up just for one moment and talk about the implications for inflation of all this stimulus. We published a piece recently where we gave 5 reasons to expect higher inflation. I'm not going to go through all of those, but there's a couple here that are particularly relevant to the election. So the full 5, first of all, if we get the vaccine soon, we may get a quick, full economic recovery. And if that happens, so unemployment goes down rapidly, then inflation could once again be on the agenda, especially since we've seen this very rapid money growth in the last year. A lot of that is due to companies borrowing, taking down their lines, and some of it may be repaid, but if some of it's spent, that is potentially inflationary. But a key point here is I think is likely to stay dovish whoever is president. And we're likely to see stimulus obviously from Biden, but perhaps also from Trump. But the Fed will stay dovish in face of that, and that is potentially inflationary. And then the high government deficits and debt, again, we're going to be there whatever happens. We calculate the net debt to GDP will be 123% by the end of next year on current trends, whoever's president. And the deficits are going to be staying high, I think, again, whichever it is. And then finally, in the piece, we talk of structural trends, the China effect joining the WTO, the big export surge, in effect, the huge increase in the labor supply globally, that effect is dwindling. So coming back specifically to the election, if you look at this is the 4 possible outcomes we have. Trump winning with a Republican Senate, Trump with a Democratic Senate, and Biden with a Republican or Democratic Senate. So I've largely gone through already the far right column. You see the infrastructure spending. Biden with the Democratic Senate would be big. We'd see the tax changes. We'd see this big time green shift. I'd like to highlight a couple of things here. I think Biden's approach to China will be different in that he will try to get a coalition together, both including Europe, but also countries in Asia against China. He'd probably be less confrontational in a sense, certainly less transactional, which is being Trump's approach. He's probably going to be more effective in negotiating things out of China, but I think, as I say, less confrontational, and that's probably good for markets generally. We'll see a dialing down of the trade wars, whereas I think if Trump is re-elected, we'll see them potentially ramped up, and especially to the list. In terms of the UK, UK wants a trade deal. It's under negotiation. It needs to be negotiated by April next year to get fast track authority in the US, which is essentially an up or down vote in Congress. I think it's more difficult with Biden, but not impossible. And finally, on the stock sectors, which Gerry's going to talk about some more. I mean, I would highlight obviously the green agenda is going to be particularly positively affected if Biden and the Democrats win everything. But the infrastructure sector and also the industrial sector. But notice also if Trump wins with a Democratic Senate or if Biden wins with a Republican Senate, we still think you'll see infrastructure and industry doing well. The other possibility that we stay where we are with Trump and a Republican Senate, then I think it's probably the big banks do relatively better, oil and gas potentially do better, and the tech companies, if you like, the moat companies, the companies that do well with COVID-19, they do better in that environment. So I'm going to pass on to Gerry from here.
Hi. So if we go to the next slide, John. And here you can see our view on what happens if Trump wins and the Senate stays in control of the Republican Party, pretty much status quo. And what we're looking at is big banks might do better. And for that, we're looking at the KBW index on the top left-hand corner. That it covers, I think, 24 of the biggest banks. And you can see that they've rebounded a little bit since the March trough. But in general, we would think the regulation side of events would favor those. And this is all in some sort of relative value sort of outlook as well as absolute. We would suggest that energy shares, which are obviously at rock bottom levels, historically speaking, that's the chart on the right at the top, would probably do better under Trump than they would under Biden, on the view that he seems to like to back them and support the whole shale exploration idea and the general big producers as well. And unfortunately, we think the tech bubble, if you want to call it a bubble, the drive into the technology shares, given the fact that they seem to be COVID proof as far as the market's concerned, may continue, as his approach to dealing with the pandemic in the US doesn't seem to be giving any quick results. Next chart, John. This is where it gets interesting. As John pointed out, we had three columns where it seems that infrastructural and industrial sectors may do better regardless of whether Trump or Biden is elected. But the whole idea here is that if Trump wins, but the Senate turns to the Democratic Party, or if Biden wins and the Senate remains Republican Party held, then infrastructure and industrial sectors may do better. On the left-hand side, we have the index that tracks infrastructure shares. This would be things like basic materials, utilities, as well as construction. And it's rebounded sharply, as you can see from the March trough. But we would think that would hold up pretty well under either of those scenarios. And we would think that the industrial sector in the S&P would, again, hold up pretty well under both of those scenarios. Next slide, please, John. And in this one, this would be what the polls seem to suggest might happen, which is Biden wins and the Senate gets controlled by the Democratic Party, in which case we would, again, suggest that infrastructure might do well. That's a top left-hand slide. And we would think industrials would do okay, given the infrastructure spending. That would be the bottom left-hand slide. And for the idea that green sectors might do well, I looked here as an index, the Invesco ETF, mostly because it's around 70% made up of companies that are based in the US. And you can see it's already done very well since the summer, and especially since the March trough. But there's the idea that this could do better. So it's one of those things where if you try to catch broader shifts in the market, we're talking quarters and years rather than immediately after the election. This is more of a relative value idea. And the idea that COVID-19 mode sectors might come under pressure is kind of the relative value idea. The chart on the bottom right looks at the technology sector compared to the industrial sector. And as you can see, the big spike that happened around the millennium was the dot-com bubble, where everybody had an idea for a website that would make them a billionaire by tomorrow. We're not quite at those levels yet, but it's one of those things where the sheer outperformance of the S&P 500 technology sector relative to the industrial sector does catch the eye. And it's one of those things where you kind of think, well, something's going to be rebalanced here at some point. So we would suggest that if the market takes the view that Biden would do a more sensible approach to dealing with COVID, then you might see some of the COVID-19 mode sectors come under pressure on a relative value basis. Next slide, please, John. Now, this one looks really complicated, but it's actually quite simple. This is the U.S. 2-year and 10-year note yields, and then the spread between them. That's the 10-year yield minus the 2-year yield. And that just gives us the coupon curve. The coupon curve is in red. As you can see, it narrowed or flattened quite sharply during the pandemic at the tail end here, and started to steepen a little bit. Now, the 2-year yield is anchored by the Fed. So if the Fed has rates near zero, the 2-year yield isn't going to drift too far away from there for the most part. The 10-year yield has been pressured up to near 1% over the summer, but it seemed to us and to the market that the Fed kind of is trying to hold that line there on the view that they want to supply the market with low yields and lots of money to encourage the economy during the pandemic. As John pointed out, one of the big risks that we see
Hello, Gerry.
Jerry. Oh, seems I lost Jerry. I'm not sure
Hello.
what Jerry was about to say.
Ah,
Are you back, Jerry?
Can you hear me now?
Yes, yes.
I hope so. Okay, sorry about that. One of the big worries that we have here is that inflation might spark up, and the market is betting that the Fed is going to try to hold 1% in the 10-year. If they don't hold 1% in the 10-year, though, we think that this yield curve could steepen further. Next chart, please, John. And here we are looking at currencies. And the reason we're looking at currencies is this will give us a lot of information about the way the market sees everything: Fed policy, infrastructure spending, inflation, deficits, politics. They all come into the dollar one way or another. So we're looking at dollar Swiss, top left, euro dollar, bottom left, dollar yen, top right, and sterling against the dollar, which is the bottom right. In all these scenarios, it all reflects on one, what is the Fed going to do? And we've been going about this for the last 3 months, like I'm sure you guys have and your clients have, and trying to figure out, will the Fed raise rates or will they let inflation run hot? Given the Fed's recent comments or the comments of the last few months, it looks like they're going to go for the average inflation and they could let inflation run hot. However, if the economy is doing very well and if inflation is picking up, we don't think the Fed's going to stand on the sidelines for too long. So therefore, our dollar view is predicated on, will the Fed actually let the bond yield go above 1%? And will they signal to the market that everything's going well? Therefore, we will raise rates at some stage, which the market is definitely not looking for. So our dollar view is broadly positive if the view is taken that some inflation comes through and the Fed won't hold 1% in the US 10-year yield as the ceiling. Next chart, please, John. And this comes through on gold, where right now the market is betting, seeing as we saw new all-time highs in gold in dollar terms over this year, that inflation is going to be a problem and fiat currencies and the dollar will be under pressure. If those come under question, then gold may see prices come down a bit. If, however, the Fed says, okay, we're going to let inflation run hot, we're not going to raise rates, and we're going to try to keep a cap on the long bond yield at 1%, then I think, like, if the dollar does fall, then gold prices may head higher as well. Next chart, please, John. And here we are looking at China. And the reason we're looking at China is because, as John outlined, no matter who's the president, there's going to be some leaning towards constraining China's ability to challenge the U.S. in some ways. I mean, it's one of those things where the U.S. has and the world have some legitimate concerns about some of the Chinese practices, which has been trumpeted by Trump, if you will. And even though we may not agree with it, at some stage, something, quote unquote, is likely to happen to try to constrain some of the practices. So here we are just looking at the charts saying, yep, Chinese stock market did very well during the initial part of their WTO entry in the mid 2000s. And then you had the spike higher and the collapse since 2015, and it's been kind of flatlining since then. In terms of the CNY, we would suspect that the currency is probably going to strengthen a bit against the dollar if the U.S. policies, as we outlined before, start to undermine the dollar against other currencies. If the dollar does well against everybody else, though, chances are the CNY may be a little bit pressured and come back to the 7.2 area. Next chart, please, John. And this is where James is going to talk about volatility as a consideration for the market.
Yeah, thank you. I'll be very quick about these two slides, really. Some of you probably are interested in volatility on the S&P 500 index, purely because structured product activities, hedging, using derivatives. So I'm going to mention it very quickly. So what we are having here is a chart. The blue line is the VIX index, which measure the short-dated option volatility on S&P 500. So this index been there for quite a while, but as you can see, as the pandemic start, it rise sharply, and then it falls. Over the summer, it falls back as the market recover, the red line below, but is at the moment still above what it was before the pandemic. So the question for everyone is that will it be staying high if there's any uncertainty from the presidential election? For example, especially when there's a deadlock, when Trump is contesting the result or Biden contesting the result. I think the general view is basically that this probably will actually elevate volatility in a very short while, but it probably won't last that long as soon as there's some signals that actually that will be resolved. We saw that during the 2000, remember the hanging chat thing between Al Gore and George W. Bush. We have that exact same issue that's contest about the results. And as soon as there's some indication that it's going to be resolved by the Supreme Court, volatility dropped. So that's on short-dated volatility. Next chart, please. Now, this looks really complicated, but what it does is basically we use the WIX futures, and basically that tell you the volatility, not just now, but also in future. The line really we want to look at is the red line, that is the near month, that is the closest day, shorter dated options, and the black line, which go into April 2021, about 5 to 6 months from here. So what I'm trying to say here is that actually you look at what happened during the summer, on the August and September, the red line is that line. What it means is that the short-dated volatility drops because markets seem to recover, but there's nothing moving on the long-dated volatility. And in fact, you look at it all the way through, the red line start to rise a bit because of COVID worry and also some correction in the equity market. Black line hardly moves. Now, for those of us here who do structured products for long-dated thing, then you do long-dated structured products or long-dated derivatives, then this is important because actually long-dated volatility is not moving at all, despite all these noises of COVID, presidential election. So despite what I said about possible rise in volatility due to presidential election, bear in mind that for long-dated options on the volatility side, S&P 500 may not actually matters a lot. And this is important for people who are among our audience who may be doing longer dated structured products. And if you want to play this volatility, try to sell volatility, probably you'll be better off looking at short dated volatility in case presidential election comes into a stalemate situation. Now, this for the index. We haven't actually showed charts on individual stocks or sectors. If any of you basically want for us to do a bit more research into this, we're happy to help you and work on this. And you can contact us later on. Watch this space on your email, watch our website, and watch LinkedIn. Thank you for attending.
Thank you, James. Cheers, bye.
Thank